We believe that Lanka IOC PLC will continue to record strong and sustainable earnings in the medium term and would like to give you a quick update on the market dynamics, financial forecasts, and valuations on this counter. Given the shortage of US dollars for fuel imports, lack of funds, steep increases in the prices, and the slowdown in the Sri Lankan economy, CPC's auto fuel sales contracted significantly in 2022 and 2023 on a year-on-year basis. Based on the data released on the monthly retail and consumer sales by CPC, it is evident that a significant decline was experienced across all product categories. On a year-on-year basis, Lanka auto diesel volumes declined by 53.22% and 92-octane petrol volumes declined by 28% in January 2023. Despite the steep decline experienced across CPC sheds, impact on LIOC's volumes were minimal. Given LIOC's strong financial position, access and availability of US dollars, the company was able to consolidate its market share due to the void created by CPC. Accordingly, LIOC's market share increased from 17% to approximately 25% during the second half of financial year 23. In line with its plans early on this year, LIOC is on track to add 96 new filling stations over the next 12 to 18 months. This will contribute to a further increase in LIOC's market share and strengthen its position. LIOC's managing director mentioned that the company will open 37 new sheds in March alone, which will contribute to strong sales volumes in the first quarter of financial year 24. Given the less dependency on CPC, a market-based pricing formula approach is expected to continue. The market-based energy pricing is critical and is an important element of the fiscal consolidation reforms required for the success of the IMF EFF program. The continuation of the fuel price formula will lead to a favorable, efficient, and stable operating environment for all market participants and ensure sustainability in earnings for LIOC. As reflected in this slide, the pricing formula considers landed cost, processing cost including transportation, stockholding cost, taxation, production, operational and administration costs, and profit margins. As you can see, based on the prices as at the 1st of March 2023, CPC makes a profit across all products including petrol 92-95, auto diesel and super diesel, and therefore LIOC will make a much larger profit given their operating efficiency and reduced finance cost. A further price reduction was announced today to take effect from 30th March 2023, where fuel prices have been reduced across all categories. 92-octane petrol was reduced by 60 rupees to 340 rupees, 95-octane reduced by 135 rupees to 375 rupees, auto diesel reduced by 80 rupees, and super diesel reduced by 45 rupees. This reduction was anticipated given the reduction in global oil prices, which is a factor considered in the fuel price formula. The reduction in prices may contribute to an increase in volumes over a period of time with the expected revival in economic activity. On the 27th of March 2023, the Minister of Power and Energy stated that Cabinet approval has been granted to award licenses to 3 global players to enter the fuel distribution space in Sri Lanka. Sinopec, United Petroleum Australia, and RM Parks of USA in collaboration with Shell PLC are expected to enter the market. The companies will be granted a license to operate for 20 years to import, store, distribute and sell petroleum products in Sri Lanka. The pie chart on this slide reflects the total number of fuel stations that will be operational across all players in the future. It is estimated in the medium term that CPC will operate 740 stations, while LIOC, considering the new 96 sheds that are currently underway, will operate 309 stations. 450 existing CPC fuel stations will be allocated equally to the 3 new players, resulting in each of them obtaining an allocation of 150 sheds. A further 50 fuel stations at new locations can be established by each of the new companies. We are unable to ascertain the market share going forward at this point in time, only based on the number of fuel stations, as other factors, including the location, distribution and market entry strategy, etc., will need to be considered. Liberalization is expected to foster healthy competition and a more efficient industry. Through the liberalization and less dependence on CPC, a market-based pricing approach is expected to continue. This will lead to a favorable, efficient and stable operating environment across all market participants. As mentioned previously, the location and distribution of the fuel sheds among the new players has not been announced and finalized, and thereby we are unable to ascertain their market share at this point in time. Despite the entry of new players, we expect LIOC to have a competitive edge given its first mover advantage and continue to record strong, sustainable earnings due to its brand presence, built up infrastructure and customer loyalty built over its 20-year presence. Further, it must be noted that LIOC plans on increasing their distribution by adding 96 fuel stations within the year, of which 37 are expected to commence operation by end of March 2023. LIOC is also making headway to increase their storage capacity for both automotive and bunker fuel. This is being done through a joint venture with CPC, where LIOC holds a 49% shareholding of Trinco Petroleum Terminals Limited. This was set up in January 2022 and will develop 61 oil tanks at the Upper Tank Farm in Trincomalee. The company hopes to refurbish 10 tanks with a capacity of 10,000 metric tons each in Phase 1. And the remaining 51 tanks are expected to be refurbished at an estimated cost of $42 to $50 million. The storage capacity is in addition to the 14 tanks that can be used by LIOC in the Lower Tank Farm on a 50-year lease. The enhancement in storage capacity will contribute in strong revenue generation for LIOC in the medium term and offers opportunities for both in Sri Lanka as well as offshore. It must be noted that LIOC also has a 33 1/3% shareholding of Ceylon Petroleum Storage Terminal Limited, also known as the Common User Facility. This is a JV with CPC, and this company operates 13 oil terminals across the island. Over to you, Hasita, to go through the financial forecast and valuations.
During fourth quarter of financial year 2023, crude and refined petroleum prices declined due to lower demand and fears of recession, causing a slowdown in economies across the globe. Brent crude decreased from $85.91 on the 31st of December 2022 to $76.41 on the 28th of March 2023, which is a 11.06% decrease. Meanwhile, in Sri Lanka, on the 3rd of January 2023, excise duties and taxes were increased by 25 rupees per litre across each fuel type. As a result, duty on a litre of 92-octane petrol was increased from 27 rupees to 52 rupees, while the duty on a litre of Lanka auto diesel was increased from 6 rupees to 31 rupees. As excise duties are accounted for in the fuel price formula, 92-octane petrol prices were increased by 30 rupees per litre, an 8.11% increase in prices. This is despite global prices coming off by almost 12%. As a result, we forecast the company to maintain its strong profit margins in the fourth quarter of FY23, as the price reduction was only implemented from the 30th of March 2023. Given that the economy is highly reliant on Lanka auto diesel and diesel price increases result in greater inflationary pressure, the government did not increase auto diesel prices despite the increase in duties. We do not expect CPC and LIOC to be negatively impacted in terms of lower margins for auto diesel compared to the third quarter of FY23, as the 6.17 increase in taxes is offset by the 12% reduction in global crude prices, as well as the benefit from the LKR appreciation not being passed on to customers until the 30th of March 2023. As you know, the LKR appreciated by 11.14% from 363 rupees per dollar to 322.67 rupees per dollar from the 31st of December to the 28th of March 2023. The 11.14 appreciation of the rupee, which positively benefits LIOC, was not passed on to consumers until the 30th of March 2023. Therefore, LIOC should maintain strong GP margins in the fourth quarter of FY23. Even though the decline in global prices was greater than the increase in taxes and the benefit from the LKR appreciation was not passed on to consumers until the latest price revision on the 30th of March 2023, we conservatively forecast that LIOC maintains GP margins of 16.04% in the fourth quarter of FY23, in line with the 16.04% recorded in the third quarter of FY23. Previously, we had forecasted that 35 plus new sheds would commence operations during the month of January to March 2023. But due to the delays in opening these new sheds, we revised down our revenue assumptions for the fourth quarter of FY23. Also, due to the slowdown in economic activity, we have assumed a 5% decrease in auto fuel sales volumes in the fourth quarter of FY23 compared to the third quarter of FY23. As a result of the decline in revenue in the fourth quarter of FY23, net profits to equity holders is forecasted at Rs 7.65 billion. Moving on to financial year 2024 forecast, we have forecasted the company to maintain a GP margin of 16.04% throughout the first half of FY24. Given the competition expected from the three global players in the second half of FY24, we have conservatively assumed GP margins to decrease to 14% in the second half of FY24. Given the increase in the number of new sheds, we expect the increase in inventory and the extended working capital increase in inventory to also increase the working capital cycles. Fuel prices are forecasted to remain in line with the prices revised on the 30th of March until the first half of FY24. Thereafter, we forecast more competitive pricing for retail fuels as new entrants Sinopec, United Petroleum and RM Parks, in collaboration with Shell, to commence operations. We forecast an increase in sales volumes in FY24 compared to the second half of FY23 due to the lower retail fuel prices and a pickup in economic activity given the current macroeconomic stability and lower interest rates. We have also assumed that $20 to $25 million of capex requirement for the first phase of the Trinco storage terminal investment will be fully financed from internally generated funds and not through debt. In order to ensure strong cash reserves to finance capex and fund the working capital cycles, we have revised down our dividend payout ratio for financial year 23 and financial year 24, resulting in low dividend yields for the same period. We are forecasting total revenue of 282.98 billion rupees in FY23, an increase to 339.58 billion in FY24. The increase in revenue is due to the pickup in sales volumes from the increase in economic activity and the increase in contributions from the new sheds opening in the fourth quarter of FY23 and throughout financial 2024. due to the conservative GP margins of 14% assumed in the second half of FY24, EBIT for financial year 24 is forecasted to decrease 17.23% compared to FY23 to 37.34 billion rupees. Due to strong cash balance forecasted for financial year 23 and 24 and low levels of debt, we forecast net interest income to offset the decrease in EBIT to some extent during financial year 24. We forecast total net profit attributable to equity holders of 38.19 billion in financial 23 and 34.17 billion for financial year 24. At a market price of 169.5 rupees, the share is trading at a PER of only 2.37 times FY23 forecasted earnings and 2.64 times FY24 forecasted net earnings. Before we delve deeper into LIOC's valuation, it's best to restate some of the salient features that drive our investment rationale and valuation. Firstly, LIOC's strong financial position should be considered given its strong net cash balance of 25 billion forecasted for FY23 and 20.26 billion forecasted for FY24. This results in a very low debt to equity of 17.56% and 11.39% forecasted for FY23 and FY24 respectively. As stated in our previous webinars, LIOC enjoys a higher net profit margin compared to CPC, and as long as the pricing formula for fuel continues, the company will maintain strong profitability in the future. In addition, the management is increasing the contribution from high margin branded fuel segments that will ensure strong GP margins to continue in the future. With the company adding 96 new filling stations across financial year 23 and 24, the company will increase its market share to above 30% compared to the current market share of 25%. As stated in the previous slide, the company trades very attractively at 2.37 times FY23 net earnings and 2.64 times FY24 net earnings in comparison to significantly higher historic PERs, which ranged from 4.29 times to 22.97 times during FY19 to FY22. We have conservatively assigned a PER of 5 times lower than the market PER for fair value calculation. The reason for lower multiple is considering the risk associated with the liberalization of the auto fuel market as well as the political influence on the industry in deciding whether the fuel price formula will be continued indefinitely. At a PER of 5 times FY24 net earnings, we arrive at a fair value of 320.75 rupees with an upside of 89.23% with the current market price of 169.5 rupees per share. Considering the capex forecasted for FY24 and the extended working capital cycles for the new sheds, we have revised down our dividend payout ratio in FY23 and FY24 to 3.5% and 5% respectively, which results in a dividend yields of 1.48 and 1.89% in FY23 and FY24 respectively. As we stated in our previous presentation and webinars, it should be noted that the fair value is a reflection of fundamental net earnings forecast for financial year 24 and does not consider the investment sentiment and or adverse impact to the stock market sentiment resulting from possible adverse economic conditions in the future. It also should be noted that the fair value is not a target price.